So, welcome again to a new episode of Casting Strategies. In this case, I have the honor, great honor, of interviewing Wes Gray. Wes actually doesn't need introduction, but anyways, I'm gonna say a few lines. Wes Gray is the founder of the management company Alpha Architect, author of books like Embedded, a Marine Corps advisor inside the Iraqi Army, an account of his 8 months military assignment in Iraq, and co-author, together with Tobias Carlyle, of Quantitative Value, a practitioner's guide to automating intelligent investments and eliminating behavioral errors. He is portfolio manager and ex-associate of professor of finance at the University of Drexel University's Bennett Liebau College of Business. Wesley Gray is, for me, and this is a thing that I have to say, is one of the greatest educators regarding finance in the world, actually. Very likely he wouldn't say that because I know that he's pretty humble and he wouldn't say that, but he's not aware about the power that his Alpha Architect company has when you want to learn something regarding finance. His white papers, his articles, the Alpha Architect articles, the team actually, because they have a great team, and they write a lot about investments and how to understand finance. So this is a great honor for me, and I hope you guys enjoy as as I'm gonna do, because I'm totally sure this is an incredible opportunity. Wes, thank you for being here. It's awesome for us that you show up here and you granted this interview. So I have a question for you. That is, tell me about how you got into investing, and your journey from being a captain in the United States Marine Corps to a quant-driven factor investor. So what was that journey like?
Yeah, well, it's
Don't forget to mention Eugene Fama.
yeah, sure. Yeah. So my journey, I would say, is very up and down, right? So originally, going way back when I was a kid, I actually grew up on a cattle ranch, and we used to raise steers and what have you. And it was probably like, I don't know, 10 or 11, and I was like $1,000, and my dad, he's a ranch cattleman. He doesn't know anything about investing, but my grandma was like really into Warren Buffett, right? And so at the time, my dad's like, hey, go talk to your grandma. She knows how this investing stuff works. And she had me start reading about Warren Buffett and like Ben Graham and everything. So I originally kind of started off just thinking, wow, this is like value investing makes so much sense to me. I hate doing manual labor. Like, you can make money just with money. That seems like a good way to go, because digging ditches is not fun. So that was kind of like the original inspiration. I just was tired of being broke and wanted to, get rich. So I started off stock picker, old school Ben Graham, Warren Buffett value. And I did that literally since I was a kid. And then once I went to college, obviously I got more involved, kept trying to launch, hedge funds and what have you. And then after undergrad, I got into University of Chicago in the PhD program. And even during that time, this was around, I've been really getting serious like 98 to, this was 2002 at this point. I was still doing stock picking. But in the PhD program, every single day you're learning about quant and, Eugene Fama, Nobel Prize winners telling you, hey, stock picking is for idiots. Why are you doing that? But at the time, I was like, well, no, that's just because you're an old guy. Stock picking is still the way to go. So long story short, I did that, and that was in the early 2000s, and I had a really good run because, as you know, just anyone who threw a dart at small cap value stocks was making a ton of money. And at the time, I thought I was a genius because, I was picking basically small cap value stocks, right? I didn't know it was just because I was just buying those characteristics. I thought it was because I was so smart. So fast forward to 2008, I kind of wanted to be a quant at that point, but I kind of still like stock picking. And I actually ended up launching a hedge fund when I got out of the military. I launched a hedge fund literally in September 2008, which you probably remember that's when
Yeah.
like the financial crisis happened. So I literally decided to
You hit
launch
the nail.
this, this stupid like value hedge fund. Like we had like $3 or $4 million at the worst time ever, right? And that fund was quant because I was like, all right, stock picking is good, but Fama and all these folks have kind of taught me that maybe I should be systematic. And of course we did that. But then as we launched 3 months later, it was December, and the world had blown up, and I started finding all these opportunities where you could buy firms for less than their net working capital, which is an old Ben Graham strategy. And then me thinking I was a genius again, I went back to our clients and I said, can we please switch back to stock picking? Because this is the best opportunity of all time. This quant stuff is for the dogs. Why would we do this? So I went from originally stock picker to quant, and then I went back to stock picking in December of 2008. And then obviously I stopped being a quant, went back to stock picking. And then long story short, we did that for, I don't know, 2 or 3 years, actually about 2 years, and enjoyed insane volatility, like really bad performance and really good performance. But in net, it was like the Russell 2000, but with 5 times the volatility. And after that episode, I was just like, all right. And then we end up back testing, like, what if we just done the quant model that we started with as opposed to changing to this stupid, stock picking thing again. And of course it would have beat us. Right. And so that was for me, the last straw. And that was around basically 2010 when we started Alpha Architect. And I was just like, I'm not doing stock picking ever again. I'm doing models. I'm doing the computer. And no matter what, like my stupid brain tells me about how smart I am, just don't believe it. Follow the models. So ever since then, I've not traded ever since 2010, I've not traded like a stock based on my, my thoughts. And I like it like that, man. So my history's been very up and down.
Well, it's super funny and super clear, because it happened that idea, that journey, is super clear, and it's a way to say, oh man, okay, now I know that I have not to believe my brain,
I know.
It's totally clear.
But the key thing to emphasize on that is because I lived through it of thinking that, oh, I need to go back to stock picking, is even me, who's been trained by the best people in the world that told me that was a bad idea. Yeah. I still did it. And so I don't know how to get other people to learn from my bad lessons. you sometimes just need to get punched in the face in order to learn.
I don't want to tell you, because in here, when you say about these kind of things, and I was talking a few months ago with Jeff Graham also, and he was in the Columbia, is teaching us as like you are in university. And we were talking about, especially about this idea of you study with the heads up. I mean the high end teachers and investors. So imagine what happens here in Spain. You can't even imagine, man. So we need you to teach us. This is our great job, I think, that we are doing here. So it's awesome.
And that's honestly what. It kind of inspired like our firm mission, Empower Through Education, is I just had personally been destroyed and beat up and humbled so many times over that we just said, hey, let's just create a mission where let's just help other people learn about this stuff so they don't like screw up all as bad as I have. And so that's what we're trying to help people out on. But even then, to your point, because we deal with like normal people that they just read about Tesla or Bitcoin, and they're like, oh, all in, which is fine. But we're just trying to provide an outlet where people can at least try to get smart and make better decisions and not do bad things like I've done in the past.
It's totally clear, and we appreciate it. We appreciate it. So I
Sure.
have another question, Wes, that is following in Gene Pharma research, studying and testing all the data available, because you have done
Yeah.
it. Have you found what works on the stocks in the stock market over time? So what is for you your take on that?
Yeah, so I mean, the high level takeaway that I've learned just time and time again is that there really is this idea that if there is no pain, there is no gain, right? And sometimes that pain is hidden, right? And I'll explain that. So as long as you always remember that basic idea that money doesn't grow on trees, which sounds like an obvious idea,
Yeah.
as long as you always start with that assumption, you usually can't screw it up too bad, right? So under that assumption, and that's kind of what we now look for, is like, hey, we're going to do all this data analysis. We've studied every data point, every system that you could ever imagine times 50. Kind of the summary of I guess, what works in the sense that it can generate higher extra returns over the long haul is basically kind of three factors, right? The first one is equity risk. Like obviously you got to be in stocks to earn higher returns because other asset classes just, won't do it. Like that's an obvious one, but sometimes
Yeah.
people forget that. You got to own beta to make any money at some point. And then the only other two factors that we really like are value, which is essentially just buying cheap stuff that everybody hates, basically. And then on the other side of that coin is momentum. So literally buying everything that everyone loves at the time. So as long as you're in those two extremes, those seem to be pretty productive ways over the long haul to generate, excess returns. However, again, going back to the mantra of no pain, no gain, whenever you look at those strategies that earn extra money, there's a reason, right? Well, when you own stocks or beta, like you can lose half your money. So there's a reason you earn extra return. Value is not necessarily more risky than the market, but the problem with value investing is on a relative basis. It can sometimes be way under the market for years on end or way above the market. And to the extent that people don't like having to look at, the market and they're always under it, and makes them feel bad. That's kind of its own form of risk. We call that career risk. And that's the same thing with momentum. So value and momentum, in our opinion, are great ways to earn excess returns over 10, 20-year horizons, but it's not easy because you can go through periods of, 5 or 10 years where, you wish that you just bought the market. And in theory, that shouldn't be a risk because if you're a 20-year horizon investor, who cares about relative? But everyone always cares about what their neighbor has, right? Even though they shouldn't, they should just be happy with what they got. But in investing, just like, when people care about what the neighbor's doing, they have this problem with relative performance in the short run.
And do you think we could say that value and momentum factor are uncorrelated? So we could combine both at a time in order to better control the risk?
Yeah, exactly. Like the easiest way to explain it for just normal people, if you don't know anything about investing, is I look at value as like fear and greed is something that everyone talks about in the marketplace. Like value investing is fear, right? Because you have to buy things that everyone hates. The future's terrible. Like, why would you want to own this stupid old company that's going to definitely go bankrupt, right? So you're just playing on the fear trade. And then greed is the momentum trade, right? That's like everyone it's gone up 100, but it could go up 200%. And so the idea is value and momentum are just systematically kind of exploiting these human biases in a way that's, I think pretty straightforward. And if to the extent you can combine them because they're kind of opposite, ways of thinking about the marketplace and why one's going up, the other one's often going down and vice versa. If you can believe in both and put them together, to your point, in general, it'll help kind of smooth the ride. Whereas if you're all in on fear or all in on greed, that ride is maybe it'll be good over the long haul, but in the short run, it could be
Exactly.
super challenging, I would say.
It's super interesting because here in Spain, what happens very often is that there's this value idea, not even factor, because a lot of people here, they don't see value as a factor, but as a brand, kind of a brand, and they buy the brand, and there are many fans, and they say, no, I'm value guy, so you're going to buy it. The people is going to buy it. So, but the point is, what I see is that they're concentrating a lot in one factor, one idea, one brand, and they suffer the pain because there's a lot of pain accompanying with this kind of strategy. So this idea of combining different factors at a time, it sounds very good to me, because it's, what I see is that this uncorrelated idea can smooth your volatility, the global volatility of your portfolio. It makes all the sense to me. So thank you.
Yeah.
I have another question, Wes, that is, if you were to create a particular portfolio, because you are a manager, and then in your case, your funds, you manage a lot of money, so you can have a pretty diversified portfolio. I mean, we have learned many things from you regarding how to build the portfolios, the processes that you use, even that you use some ranking value, and then on top of that, second ranking with quality, for instance, in order to avoid this kind of value traps, let's say, or things like that. So it makes all the sense to me. But how would you create a portfolio if you were a guy to create a particular portfolio? So I'm going to have my account, and I want to have 30 stocks, 40 stocks, 15 stocks, I don't know. And what kind of rankings would you choose?
Yeah, so I mean, everyone is different, and it totally depends on, obviously, like your horizon and your willingness to stick to a program. So what I'll just tell you is what I do, obviously, with my personal money, but that's not for everyone, but it's just how I think about it. So, and maybe it'll give you a context or an anecdote about at least one random dude's opinion, right? So for me, we like our products are basically, I put all my money in our own products because I build our strategies for my money too, right? Because just that made sense. Like, I don't care what other people are doing. I'd rather just, if I'm going to do it, let's just build it and use it. So my basic idea is listen, I actually have a long-term 20-year goal because I don't spend a lot of money. I got pretty low cost living structure. I'm happy with what I got. And I just don't need this money for literally like 20 years. So I can take a lot of risk, and I don't care what the S&P 500 is doing today or tomorrow. So that's my profile. Some people aren't like that, but assuming you have like literally a 20-year horizon and you just want to try to earn the highest return possible in a sensible way, the first rule of thumb is obviously diversification. So, and so one question is, well, we could have 10 stocks. That's kind of diversified, but pretty damn risky. We could have 10,000 stocks, but that may be way too diversified. And there's no real right answer. For me, it's like, hey, if I have a stock portfolio that's like 100 to 200 stocks, that seems pretty diversified in aggregate. And could you argue for 100? Yeah. Could you argue for 50? Could you argue for 3? Sure. But let's just say what I end up basically doing is there's around 200 global securities, right? So 200 securities. And then the other part of diversification is let's not just be all in on the US or all in on Spain or all in on Italy or whatever. Like, let's also diversify geographically, right? So we, in general, are going to try to allocate those two. Let's say we have the 200 stocks. We're going to now try to, make sure those are balanced around the globe. So in our case, it's basically around 50% US, 50% international. And that's because that approximates like how much the US market is relative to the rest of the market, right? So that's one level of diversification there. Well, there's so the 200 stocks, so don't be all in on anything. Make sure you diversify it across regions. So don't be all in on like the US or Canada or whatever. And then the third element, back to our original discussion, is I'm a huge believer in value, like buy cheap stocks that everyone hates, but to your point, make sure they're the highest quality stocks that everyone hates. And so for about 100 of those stocks, their value, like deep value, the fear stocks. And then for the other 100 stocks, it's like the high flyers. It's the momentum stocks, right? It's the winners, because the winners keep generally on winning. And then that's what my book looks like. So it's going to be 200 stocks, globally diversified, mixed roughly equal between really cheap, hated companies and really crazy, exciting companies that have been doing really well recently. And that's what I do. Global value momentum portfolio, pretty concentrated.
It's super clear. I think, as you say, it's what I see is that this idea of combining deep value companies and then a second rank with quality, I see that it makes all the sense, because you are choosing the highest quality companies among the cheapest one.
Yeah.
So it seems to be totally reasonable. So I see that is, I don't know, I like it a lot. And in momentum side, in your case, I mean, in Alpha Architect case, the momentum side, it uses also, or does it use also this quality side among the momentum stocks?
Yeah.
You do it also in Alpha Architect?
Yes. So the way, and it's a weird thing, because like I'm much more wired to value, because it's so much more intuitive to me. And that's how I start off reading Warren Buffett books and Ben Graham books. So to your point on the value side, hey, we want to buy really cheap stuff that everyone hates right now, but we obviously want to make sure that amongst those, they're the ones that are the highest quality. So they're making money, paying down debt, buying back stock, just common sense things. And that's the religion of fundamental value investing. And then there's this other religion that we're talking about here, which is momentum, which is more like the technical, sentiment-driven, and frankly has nothing to do with fundamentals. Like if you look at a momentum, well, it kind of has something to do with fundamentals, but it's a little bit trickier. But really the momentum trade is all about the greed, the sentiment, like where is the flow, the trend. So what we do there is we want to look just at who's the biggest winners, right? We want to focus on like the hottest stocks basically, right? But then within the hottest stocks, we want to look at the quality of that momentum, right? And we always tell people, like, let's say there's two stocks that have high momentum. There's one stock that went up 100% in one day yesterday because they had a drug approval or they solved coronavirus. But then there's another stock that also is up 100%, but it's been going up like 50 bips a day for 200 days or something, right? So they both have 100% returns, and they're both high momentum, but obviously the path is very different. And so when in momentum, what you want to do is you want to find high momentum, but it's that steady momentum because it's less prone to crash risk. So that's all in the momentum strategy. We want to buy the winners, but we want to buy the quality winners that have that slow momentum, not the like 100% in a day type momentum.
Actually,
and that's just how that system works.
I love it. I think actually that momentum, I'm a value guy also. So, but I think that momentum, it has its part, so we have to take care of it also, and especially as you said, if you can combine both, I see that it would smooth a lot the profile, the whole profile.
And one of the things that I can't remember who mentioned it the other day, but it made perfect sense to me. It's like value investors and technical momentum investors. It's almost like politics, right? We're here in the States. It's like there's like right wingers and there's left wingers. And the reality is like the right wingers have some good ideas, the left wingers have some good ideas, but they never want to talk to one another. Just like in investing, like there's value investors and there's like momentum investors. They never want to talk together. But the reality is the best solution is probably take some right winger ideas, take some left winger ideas and mix them a little bit. It's the same thing investing. Like don't be so like religious about one idea. Like if there's multiple ideas, like the idea with value momentum, just like right winger, left winger, is maybe we could pool them together and get the ideas from both people. And that's really the high level challenge that a lot of investors have. It's just like in politics and investing, people get so like focused on
exactly.
their religion or whatever. so it's hard, but if you could do it, try to do multiple religions, and then maybe you'll be better off, is the idea.
Yeah, it's a pleasure listening to you, Wes, and I see that. I think the idea that I get from you in this case, in this interview, is that, of course, these two ideas of combining both ideas, this possibility of breaking down our own thoughts and own ideas, and not stick on one idea, just one religion, because there are other possibilities that, if you combine them properly, could have a great idea. So thank you, Wes, for this interview. It's been a pleasure, and we hope to see you in actually soon, because we're going to see you in our annual event this year. So it's going to be awesome there also. So thank you, Wes. Thank you for this interview.
Yeah, can't wait. That'll be exciting. Be a great conversation, I'm sure.
Okay, Wes. So thank you to you guys also, the audience, for attending this interview. And remember that if you like the interviews we are doing, so please give us a like and subscribe to the channel. Okay, bye-bye.